Tomorrow, the Fed announces whether or not they're going to cut rates. And judging by the odds that everybody's talking about, it is, I don't want to say a nigh guarantee that that's going to happen, but it looks like it's about a guarantee that it's going to happen because everybody's saying it's going to happen. But what does that, what does that mean to me, the layperson?
So to understand it, it's really simple. That is the rate at which banks can borrow money from the central bank and other banks.
Welcome, everyone, to yet another episode of the Real Profit, Real Perspective podcast. Can you, Mr. Ryan, believe that we've made it through yet another week?
By the skin of our teeth, we have made it. Just some days fly by, some days don't, and then we end up here in another week. And luckily, this is one of my favorite places to be, so I'm all good, man. How are you doing?
This is quite literally the highlight of my week.
That's what I love to hear.
There is on my work schedule every week, there is literally nothing I would want to do more than do another recording and figure out how we can get just a little bit better at being content creators.
I tend to agree. I
gotta admit, this whole content creation thing, it is kind of fun. It is a really nice change of pace from kind of getting bogged down in numbers every week. It is nice to do something creative. I see why people do this for a living.
I've told Kathleen, my wife, since we started the business, that if for any reason it ever fails or I get tired of it, I'm done in the financial industry. I'm going to something that does not involve numbers in the slightest. So, take that as you may. But that all to say, I agree that, dude, it's nice to not have to deal with numbers for just a tiny sliver of the week,
Yeah, when the questions aren't, hey, how do we book these debits and credits, and how do we get these accounts to reconcile, and what is the P&L saying, and it's more, hey, what do we want to talk about? It's like, God, it's so much less stress.
Yeah.
Otherwise, it's just numbers, and I know what everybody's thinking. But you guys are accountants. Yeah, we fucking know.
Yeah.
We are aware that we have done this to ourselves. We have nobody to blame but ourselves. We said, hey, let's start businesses that involve nothing but numbers, and people come to us to ask questions about said numbers. It's great.
In typical masochist accountant fashion,
I think most of the issues come from the fact that we all have a deep-seated need to just grind ourselves. That we just can't help it. It's like in our DNA. This is what we've got to do, and we just can't help it.
It makes me wonder too, on the flip side, like, is the grass really greener? Like, are there content creators out there who like really just want to be involved in like a numbers business,
I could definitely see some of them wanting to, when you're in the end stage of burnout, of really wanting to move more into, I just have a thing to do. This is my set of stuff I got to do. I don't have to worry about people. I don't have to worry about how it's going to be presented. I don't have to talk to people. I get to just do my thing, which I think for a lot of people is the appeal of going into accounting in the first place.
Yeah.
Now, we have apparently misplaced those jobs. I remember when we were working at the audit firm, I forget who said it, where it was, being a staff accountant is basically the peak of your career because you have no expectations and no actual responsibility, and it just gets worse from there.
Yeah, well, there's something to be said for just being able to like getting your headphones in, put on some good music, pull up a spreadsheet, QuickBooks, whatever you're going to do, and just fucking lock in for like 3 hours and crank it out.
Just have categorization work to do, or just have to do a reconciliation, not having to constantly be plugged in. Man, we really suck at keeping the tone positive. How are we doing? This is the highlight. This is where I get to complain, and maybe other people will listen to it as well. So it's not just on the phone with somebody complaining about it. It's complaining for an audience.
Yeah, you know, maybe our complaints will take you away from yours for just a little bit.
Kind of the misery loves company type thing. So when you hear somebody else is suffering, it makes you feel better because you go, oh, I'm not the only one that's having a shit week. So we're these two guys. Oh, thank God, it's not just me. It's also them. They seem so successful and well put together and know what they're doing, but no, their week also really sucks. That's good. Not projecting at all.
Well, now that we've depressed all the listeners out there, what do you think?
What a perfect segue. You know what? Nothing makes me more excited when I'm having a week where I go, man, where can I look for some optimism? Let's talk about the Fed.
Yeah.
Who doesn't get just absolutely jovial at the thought of whether or not the Fed is going to cut rates? Now,
yeah,
we are recording
at least it's a cut instead of the other way, where
true.
That's at least a little more positive.
Now, before we get into this, we are going to preface this with, we are recording this Tuesday, September 16th. I believe it's Wednesday, the 17th is when they're going to announce whether they're cutting rates or how much they're doing. So much is currently unknown. Although, if you go off of the odds on Robinhood's future events contracts, which I may have explored in a little more detail to get a better understanding of how those work. So as an aside, before we get into things, I do see how they get around where it's not betting. It is a financial instrument, because you can buy and sell the instrument before the event happens. It's kind of interesting.
You know, that's the great difference between the two words gambling and speculation.
If you're not totally determined on the outcome, it's just speculation. If you could potentially get out and just make money on volatility, now that's speculation. Now we're just trading.
Heck yeah, dude.
I do wonder, this is something I've got absolutely no knowledge about, but I wonder what the actual process is for coming up with a new financial instrument like that.
I have zero knowledge on that as well. I have no idea.
Like, I wonder, how do you go from the idea of, can we basically create a stock option contract for a future event? How do you put the actual mechanics of it together? Build the system, set up the pricing. Like, how... we need to find a CFA to be on here, or like an honest to God investment banker, because I know we both know oodles of those that we could call up to really explain how does that stuff actually work. Maybe in about 3 years, when we finally built up a following that gives us a platform where we could call in a favor, maybe. But that's just
super interesting.
Yeah, I'd love to know how that actually works for the creation of a brand new financial instrument like that.
Yeah, well, and then you mix that too with it being on an app and just the coding and the work that goes on behind the scenes to merge that into, the financial system. You see how much knowledge I have of it right now, but
I'm hoping,
crazy,
this is Robinhood we're talking about. So I'm hoping they didn't just chat GPT the shit. But there's a non-zero chance. But no, it was interesting to kind of see that, okay, there is a little more to it than just the binary outcomes that they talk about, because you do up until the point that the event happens. Basically, for anyone that's not familiar with what we're talking about, Robinhood has a new feature, and we are not sponsored. And we do not endorse doing this. This is speculative gambling in its purest form. So if anyone ever is thinking of checking this out, do not gamble. And if we can't stop you from doing that, make sure you're not doing it with money you can't afford to lose. Assume that whatever you're going to do is going to go to zero.
And if you or a loved one has a gambling problem, please call the gambling hotline.
Please.
Whatever number that might be.
And if you would like us to instead take your money so that, you don't get the dopamine hit of winning, let us know and we will send you an invoice. and nothing will kill your vibe faster than having to pay the accountants.
Amen.
So the way it actually works, though, because I want to make sure if we're gonna talk about something here, then I want to make sure that what we talk about is accurate. Considering just earlier today, I posted a short about misinformation in the finfluencer space and how fast it moves. So if we're gonna talk about something, I do want to make sure everybody is informed. So if you're gonna make bad decisions, at least you can't claim this. You didn't know what was going on.
Right.
So basically, the way it works is you have an event, and it's got at least two outcomes. It either can or cannot happen. They use the example of a presidential election. I'm going to use the one that I was actually looking at, and because it's going to be topical, is the Fed going to cut rates? So, no, they're not going to cut rates. They're going to raise rates by 25 basis points. For those that don't speak financial language, that is 0.25%. So 100 basis points is 1%, 25 basis points is 0.25%. They're going to raise rates by more than 25 basis points, so more than 0.25%. They're going to cut rates by 25 basis points, or they're going to cut rates by greater than 25 basis points. These are basically the things that you can bet on. So at any particular point, you have either a yes or no option on the contract. So the way the contracts work is you pay an amount to basically purchase this contract that says, if this happen or if this does not happen, I will receive $1. So at a basic example, say that things are looking like it's going to be a roughly 50-50, right? So the contract, this thing is going to happen is valued at 50 cents. So what happens is you spend 50 cents to purchase one contract. If the event happens, right, you will receive $1. So in this instance, say you buy a contract, we're going to buy one contract for 50 cents that says the Fed's going to cut rates by 25 basis points. So if that happens, you will receive $1. So your profit, to begin with, your profit and losses are defined in the beginning. You can only make a particular amount, and you can only lose a particular amount based on how much you put in and how much the potential payout could be. So unlike something like stock options, where there's more of an option for unlimited upside, or for some of them unlimited downside, your losses and gains are capped from the very beginning by the nature of how this is set up. So the most you can lose is however much you're buying the contract for. The most you can ever win is the difference between what you bought the contract for versus what you sold it. So you buy it for 50 cents. If it happens, they'll pay you $1. You've made 50 cents on it.
Yep.
Basic placing a bet. In that case, 2-to-1 odds basically is what it turns into. Now, here's where it gets a little different than a normal bet. And this is how this gets into more how stock options work. Is obviously the more likely something's going to happen, the less likely you are to make money on that. Makes total sense, right? Nobody is going to give you winning odds on a guaranteed win. The house doesn't play like that. We all know this. So let's say a month out from the Fed cutting rates, we're looking at, these contracts they're going to cut 25 basis points, and they're saying, all right, based on the volatility on it and the odds that it happens or not, those contracts are currently worth 50 cents a contract. So you could make 50 cents on it. Alrighty, 3 weeks go by. Bunch of news is coming out. Shit's hitting the fan. Nothing's going well. There's all sorts of turmoil and trouble, and everybody is basically going, yeah, they're going to cut rates. Like, it's going to happen. So you decide, all right, we're going to look at the Robinhood app and see what's going on. And then you look at those contracts. And now that same contract that you're basically saying, yes, they are going to cut rates by 25 basis points. Now, if you want to buy a contract, it's going to cost you 97 cents, because it's not that it's a sure deal, but statistically speaking, with the way volatility is and the other surrounding impacts and how that instrument has been priced, as they say, it's priced in that everybody basically is assuming this is what's going to happen. So now if you buy it, you're going to spend 97 cents, 98 cents, 99 cents to potentially get paid a dollar. So if you're looking at it now, the day before, you go, well, there's really no reason to do this because there's not really a whole lot of upside between transaction fees. You are 100% correct. But now here's the little bit of the different part, because if you hold the contract to where the event happens, they'll pay out a dollar. But it's the day before, and you see that actually those things are currently selling for 97 cents, and you bought at 50. Okay, you can actually sell the contract to the people that want to get in now and receive that payout of 97 cents instead of the full dollar, and actually basically claim your gain early, lock in your gain. And that's what makes it a little bit different from just your standard bet. I think you'd said when we were talking about it that actually has some similarities to sports betting. Is that correct?
Yeah, so, I'm no seasoned gambler here by any means, but I've done my little share of, DraftKings and that fun stuff, especially around NC State's crazy ACC championship run last year and the Final Four, all of that. So I've done a little bit of it, but you see the same thing where, early on, I went ahead and just placed bets because I'm like, I don't care what the result is. I'm fine losing this money. I'm going to bet on my team to win. So you place the bet early, and over time, more and more people place their individual bets. And that itself helps the book sort out the odds just by sheer amount of, who's putting bets on what. So if it's getting more and more likely based on the bets that are placed that the team is going to win, your odds go up and changes your payout. So you could cash out the bet before the game even happens and still make a little bit of money. You're not going to make as much as you would if you ride out the rest of the volatility or the chance, that you're leaving to divine intervention. But, that's where you could cash out, make a little bit of money, or ride it the whole way through and still have that little bit of risk that they don't win,
Yeah, you hold all the way to expiration, you could potentially get your big payout, but you also could still potentially lose things if suddenly something unexpected happens, or lock in gains and then go, cool, we've made money. Which is always, you don't want to be the bag holder, usually. I have to admit,
not usually.
Usually when you start looking at that stuff where you go, we've made enough now, we can take that. Wall Street Bets is fond of saying nobody ever went poor taking gains. I mean, like most things, when you lock in a money making opportunity, when you've got that, you by definition cannot lose money. Whereas usually when you start to have those gambling problems is where somebody goes, I'm going to run it to the end and I'm waiting for that big payoff, and then I lost it all. All right, well next time I'm going to up the bid and we're going to get more, and then that's where I'm going to make all my money back, and it's like, you need to stop.
Yeah, it's so interesting though, the similarities, because even though it is tied to a financial instrument or security, it is, like we were saying, a form of speculation, and you do risk losing money on it, I guess. But
I mean, it's one of those where they always say that there's speculation in the stock market, which is true, or not speculation, risk in the stock market. Sorry, but I think the thing to keep in mind is there are multiple levels of risk when you're looking at financial instruments. If somebody tries to act as if a futures contract, a Robinhood's event contract, a stock option contract, a Vanguard ETF, and stock in an individual company all have roughly the same amount of risk,
yep,
they are trying to bamboozle you.
100%.
The last two are substantially less risky than the first three. If you're buying stocks, you are nowhere near exposed to the same level of risk as buying options contracts or futures contracts or event contracts, which many of them have a literally predefined death date where after that point the contract can expire worthless.
Yeah. Well, and, the difference is to me that it's like the diversification of it all. Like you have different factors included in the various options. Like if you're looking at a total stock market ETF, you're buying literally every company in the stock market. So you have thousands of different outcomes that can happen versus the other end where you're betting on basically a binary event, whether something is going to happen or it's not in a certain time frame. So you're super limited on that versus the other side. Again, you have time, you have more time, you have infinite time. You could wait forever, which theoretically is what you want to do anyways to get the most gains that you possibly can. So I don't know.
I think this is just the little aside of don't gamble. Don't forget that if somebody starts talking to you about Robinhood or all that, or if you, God forbid, you start looking at the stuff because we talked about it and then selectively forgot the parts where we said, don't gamble, don't gamble, don't fucking gamble. Well, then at least be informed as to, this is what you're dealing with. I will laugh where, as I'm scrolling through Reddit and I'll see people will post on Wall Street. I don't understand what volatility. I just bought all these stock options, but what is volatility? You're like, oh my god, you're just
oh boy.
Your counterparty is so happy that you exist.
Well, because even with options, you can use those to hedge on your stocks.
I mean, that's what they're supposed to be for, is a hedging instrument.
And you can even use options themselves to reduce the risk you have with other options.
Yeah. It's not gambling. It just got kind of turned into that because people realized, oh, this has upside. We can make money with it and make bets and stuff. And when it's like
it's
COVID,
a great tool that can be misused.
Like most things, it gets twisted from its original purpose. Then everybody goes, oh my god, this is a terrible thing.
In the wrong hands.
I think that about sums up usually most of the terrible endings of things under capitalism. Is like, it went too far. We went too far. We got to dial it back. Things are getting shitty again. Dial it the fuck back.
Yeah. But too, thinking about it, like maybe this is just my lack of expertise in the area, but I don't know if there are ways. I'm sure there are strategies to reduce risk in sports gambling. Like there's probably got to be a way to like hedge yourself, I don't know what that is, but if you're placing one single bet, like your risk is 100% because you're at risk of losing your capital.
Man, I'm not a stats guy.
Yeah, me neither.
I know statistically speaking, I don't know stats. So I'm sure the ones that professionally do it, if you were like a hedge fund or something, you'd really be getting into the statistical odds of everything.
Right.
With what you described, I'd imagine there's ways to basically hedge, probably by taking counterposing bets would be my initial thing. How do you basically play both sides in that instance to have a potential, coverage or that kind of thing to kind of mitigate your losses?
Right. Like if the underdog team is a pretty big payout, you can kind of hedge it with the favored team, so you lose $50 instead of $100.
Yeah. Have a little bit of upside.
Yeah.
But on the topic of making bets, back to our original topic. Now that we've explained to everyone how options work and how futures contract on Robinhood works, so at least we can do our bit here to keep people a little more informed so that if you see people talking about that, you at least have a high level understanding of what it is. Tomorrow, the Fed announces whether or not they're going to cut rates. And judging by the odds that everybody's talking about, it is, I don't want to say a nigh guarantee that that's going to happen, but based on the betting odds, it looks like it's about a guarantee that it's going to happen because everybody's saying it's going to happen. So you work a lot with individuals, personal finance. So, we do a lot of explanation of financial topics for people. And I believe you are kind of closer to this because you deal with more things that hit the market and all that. So let's just assume, like everybody else is, that the Fed is going to cut rates tomorrow. And so by the time this episode airs, we already know definitively what has happened. What does that actually mean? They cut rates.
Ooh, yeah.
Good, okay, cool. They did that. But what does that mean to me, the layperson that has only been exposed to interest rates through, reading headlines in the news and my credit card rates and everything? Maybe I got a mortgage. I don't know what's going on. I don't even know what the hell the stock option is. I have no idea how this stuff works. What does this actually mean for the individuals if they go ahead and do this? So let's if you could explain to me, because I'm an idiot. We all know this.
No, don't say that.
Mostly an idiot. I have knowledge in a very, very small slice of things.
The salt of the earth.
I know a lot about being salty. I am a consummate expert at being salty.
So much salt.
Oh, so much salt. I learned playing League. Explain, what does that actually mean that the Fed's cutting rates?
Yeah, so to understand it, it's really simple. I think it gets way too complicated in the news. Like, it gets blown up into this argument.
Would you say it gets misconstrued a little bit?
That's the word I'm looking for. Yep. It absolutely does. So if you just look at it from the high level, like, what is it? So the Fed itself is the central bank for our country, right? So what does that mean? They make monetary policy, which means they just dictate the rules at which banks sort of play by. So they do this through one of the tools they can use is the federal funds rate. So when you're looking at an article or Robinhood betting contract of whether the Fed is going to increase rates or decrease the rate, you're looking at this specific thing called the federal funds rate. So that is the rate at which banks can borrow money from the central bank and other banks. So that, from the top of this like triangle that I'm picturing, this pyramid, like the top central bank, it sort of just trickles down into the end consumer, which is us. So all it is the cost at which you can borrow money. So how can you borrow money as a normal person? You can go buy a house with a mortgage. You could do credit cards, which you mentioned. You could buy a car and get an auto loan. So the difference between those, like credit cards, we all know there's super high interest rate because they're unsecured. They don't have a house that the bank can come repossess if you don't pay the interest on all that. So you're looking those like 20-something% interest rates usually. Mortgages, which, are a little higher than people want them nowadays, but they're still at a pretty good rate, like 6-7-ish% right now. So if tomorrow the Fed decides to cut rates, which means they're looking at their little rate, which is, I don't know what it's at right now, the federal funds rate. I guess I could look it up, but they're considering cutting it by probably 0.25, like 0.25%. So that means that sort of trickles down into other realms, which means your mortgage borrowing costs, that rate is probably going to go down a little bit. Credit cards they don't really function like that as much. But auto loans follow the same path. So it's really how much it costs for you or a business or, anybody who wants to borrow money to go and do it. So the cheaper it is, the more people are going to go out to do it, which in this case, if you look back the past couple months, in July, we got a really crappy jobs report. So companies aren't hiring as much. Inflation is still a little bit higher than the Fed wants to see it. August was pretty much the same pattern. Crappy jobs report. Inflation's like 2.9%. I think I read in August, if I remember that number correctly. A little bit higher than they usually want to see it. So to sort of stimulate activity around the country, right? Like to make people go out and buy more things using debt, they can lower that rate and have a response that mirrors that, right? Like as soon as they lower that rate, there's probably going to be a few more people who are looking to buy a house that go and actually do it. Or a business that goes out and gets another line of credit, or their current line of credit, you know, maybe has a variable rate that goes down a little bit. So lots of examples there, but you know, hopefully those kind of help it sink in that all it is just the cost to borrow money. So what they're trying to do with that is stimulate the economy and change these crappy results that are happening right now. So I don't know. Did I explain that well enough? What questions do you have?
I've got a few that came in.
Good.
So for starters, the current federal funds rate is 4.33%.
Okay, I thought it was somewhere around 4. So
it was. Now there is
Perfect.
one thing that I may fact check you a little bit. And that is basically the translation of the rate into the borrowing. Because I'm trying to remember. So I'm gonna put you on the spot with this one. I'm gonna really test your econ knowledge here. All right.
We'll see how that goes.
We're gonna hear you furiously typing in the background, and that's where we. It's like, yes, people. When you ask us questions that we don't know the answers to, we just do research to find the answers that we know are correct. With our Google is better than yours. So, what is the difference between the Federal Reserve and the Bank of England or the Royal Bank of Canada, the central banks in other countries? Now, we all know Bank of America is not an actual central bank. They are just
as much as they would like to be.
as much as they would love to be the national bank. They are not. So
yep.
When we're kind of talking about the setting of interest rates and all that, what is the difference between the Fed and, say, for example, the European Central Bank? I'm going to really test your knowledge here on this stuff, and then I'm going to mute my microphone as I Google the answer.
Oh, okay. So I will preface this by saying I don't know on it, like the exact differences. My initial guess, my best guess is going to be it serves the same function, but they probably have different tools that they use or different rules around how they use those tools. So tools being one, like the interest rate we just talked about. Two is the money supply, which maybe you heard a few years ago when the Fed, they control how much money essentially is printed every month. So you look at, it's called quantitative easing and quantitative tightening. So this would really go down the economic rabbit hole. And I mean, at that point, that's where I start to stretch my knowledge too. There are different levels of how they measure that money supply. It's like M1, M2, all of that. If you remember that from like econ in college. But
I do actually. That you're bringing up a bunch of unpleasant memories that I have unfortunately been realizing are uber important to what we deal with on a macro scale in the day to day.
Well, and that's why, let the economists deal with the ratios and the formulas. But like, if we look at it from a high level, they have these tools at their disposal to facilitate economic activity, and as it relates to banks, right? Like how much money they have to lend out or don't, essentially. So I don't know. What did your Google search lend? Am I
you're kind of on the right path, but here's some of the key kind of differences. So let's take England, for example. England has the Royal Bank of England.
Mm-hmm.
So the Federal Reserve we do not actually have a true central bank.
Yeah.
We basically have 12 regional banks. So something that a lot of people don't realize when it comes to banking, and if bankers are listening to this and say this isn't totally correct or you're totally off base on this, leave comments, please. It fuels the engagement machine.
Please.
Please leave comments. Comments are great. Good,
Tell
bad,
me how wrong
indifferent.
I am.
Oh, there's nothing I love more than people leaving comments going, "You're wrong." Oh yeah, tell me more. So, when it comes to banking, there are basically different tiers of banks out there. We all kind of know this. A lot of banking occurs basically on the scale of size. Smaller banks borrow from larger banks for what they need. When you really get down into a lot without getting too much into this rabbit hole, I feel like we're kind of going through a bit of a minefield here where every topic that we're covering could basically be an in-depth lecture on its own of here's how it actually works.
Yeah.
Basically when you get into it. So the one I'm gonna basically say one of the most important metrics that they watch in the economy is consumer spending, and a lot of consumer spending, particularly these days, is fueled by things like the usage of credit. Why is consumer spending so important? Because basically, when they talk about the money supply and the velocity of money, how long does it take for money to go from the consumer's hands out into the businesses, then to the businesses that service those businesses, and then the businesses that service the businesses that services the businesses until it finally goes back into the government, goes back around. That's the supply. Things get fucky when that velocity slows. We've talked about this before in cash flow forecasting is the velocity of money. You know, when it takes a long time for money to leave the consumers to go to the businesses, to go to the businesses, etc., that's when we start to hit those recessions. Okay. When you make it easier to borrow, so when somebody goes and builds a house, for the most part, they do not build that house with their own money. They get a loan for that. The bank oftentimes does not have 100%. Fractional banking, they do not have 100% of their deposits on hand at any one time. They have reserves because they know that pretty much the odds of a bank run are low. Not zero, like we saw with Silicon Valley Bank and a few of the other ones that failed. But for the most part, you're not going to worry about a run on the bank because of the federal insurance and all the safeguards that have been put into place because of things that have happened previously.
Right.
But basically, when you get a lot of these projects that happened, it is done with bank money. And where do the banks get their money? Usually from bigger banks when they need it. That's when they start to talk about overnight borrowing rates. Bank needs, $50 million. They don't have it on hand. They borrow it from another bank. Bank sends it over. They get the little bit of interest, covers it for that day. It clears, then they send the money back. That's when they start talking about the overnight borrowing rate. So when you go up the pyramid of banks, at the top, you have the Federal Reserve and the regional banks that then the large banks keep a lot of the deposits and basically will work directly with, right, when they start doing lending between each other. So you've got the Federal Reserve, who provides lending services to the largest banks. And then, now, obviously, I'm sure when it gets into this, every bank has to deal with it, blah, blah, blah. I'm not getting into specifics, not my realm of expertise. Again, bankers, leave your comments and explain how much of an idiot I am. I always like to learn new things. That is not a joke. I do like to learn new things. So the Federal Reserve rate is basically the first lending rate that goes to the first tier of banks. So that sets how much, when they need to do things, how much they're going to pay in interest on the money they're borrowing. So when they lend that money out, obviously that's going to get bumped up a little bit. Mm-hmm. Right? And so the farther you go, it's that Fed rate that sets basically your base interest rate on the lending that starts the entire process. Which is why when they start to cut that, when they talk about quantitative easing, when they cut that, then that means the banks can cut their rates, then that finally flows through down to everything else, mortgage rates, stuff like that. So the difference, though, is that I think I just basically did another condensed version of what you just said. which is not what I intended to say. But damn it.
Well, dude, it's like you can't talk about one of these things without talking about all of the others.
It really at times starts to feel like in order to make an apple pie, one must first invent the universe. In order to explain how the Federal Reserve is, first we must explain what was, what has been, and then what will be.
And then it all just comes back to the question of what the hell are we doing here? You know?
What the fuck does this all actually mean?
How did we invent these concepts?
I think it all started with a really shitty delivery of copper, and we invented accounting because Genghis Khan needed to tally up how much he got in treasure and how much he was going to go out to the soldiers.
Genghis Khan, the founder of modern accounting.
Yep. And then, Venice, I think double entry accounting. And then I believe it also was, I think in Islam, when they had to do it for inheritance, was where they actually invented double entry accounting. Algebra is where that came from. I think accounting and all this stuff is like the world's third oldest profession after farmers and the other world's oldest profession that I'm not going to say so we don't get in trouble. If you don't know what I'm talking about, look up world's oldest profession on Urban Dictionary. But the difference, so back to my original point, the difference, how are we different from the European Central Bank is that we don't actually have a true central bank. We have a bunch of regional banks that deal with their particular regions. The Bank of England is a true central bank. It is one entity. The European Central Bank is a true central bank. It's one entity. We have, because as Americans, we cannot do things in an efficient and streamlined manner. Everything has to be all fucky.
We can't have just one central bank.
No, what if we had a bunch? We got to have a bank for New England, a bank for South England, a bank for the South, a bank for the Midwest, a bank for Texas.
I don't want to bank at the same bank as those people.
Do you think I want my banks to bank at the same bank that Californian banks do? No, they're weird. I don't want that. I'm gonna catch their Californianness. Everything's got to be. We got all these disparate needs in different areas. You get out into, the true west of Nebraska and Utah and North and South Dakota. They got totally different needs than what New York City has, of course.
That's coastal elites,
Those coastal elites on both coasts, they got to have their own banks. They don't want to be sharing it with the Midwest and, the Rust Belt and everything else. Of course, they got to have their own thing. Basically, the whole point is when the rates drop, hopefully, everything else will eventually follow suit because then it's not as expensive at everybody in every part of the process to borrow money from somebody else. If you ever wonder, where do the fintech companies who then offer this lending to normal people get their money from? Usually comes from either investors or banks. And where do the banks get their money from? Bigger banks. And where do the bigger banks get their money from? The central bank. And where does the central bank get their money from? Well, what happens is Jerome Powell unlocks the door into the basement where they keep the money printers and just basically revs it up a little more, and it's just shits out. He revs up that money printer, goes, "Let's go, boys!" And then he holds a really demure press conference after he gets all that excitement out of his system and talks about what they're going to do for setting 2% interest or unemployment and blah 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 and all that stuff. After he's been just rocking it on the money printer. So what does that actually mean? Who the fuck knows? It's like an indirect. This is the part I do feel for the officials who have to do this stuff, because I'm going to give them the benefit of the doubt that they aren't incompetent and are trying to do their jobs and help protect the public.
Yeah.
I'm going to not be, we're not talking politicians who will be cynical about, but for these kinds of officials that are trying to do their jobs, I'm going to give them the benefit of the doubt here. They basically have indirect levers to try and adjust the behavior of hundreds of millions of people.
Yep, exactly.
I do not envy that job one bit. Trying to indirectly tweak. I can't even get people that I directly work with to do what the fuck I need them to do on a day-to-day basis. Can you send me supporting documentation? And meanwhile, we're basically saying we're going to try and tweak these rates so that through the 7 degrees of separation, maybe consumer behavior will be able to tweak this a little bit. Like,
Yeah,
man,
it is. And I mean, that's like all the things that we were talking about, this whole conglomeration of crap they're trying to influence with this one, the slightest change you could possibly make. Like, that's why it gets blown up in the news, and it's such a tense topic. Like, they are trying to figure out, should we decrease the interest rate by 0.25%? Because if we do that, it will dramatically change how things are working in the country. And like, to either extreme, that's what happens. You know, a few years ago, pre-COVID, I guess, like when we were at absurdly low interest rates for mortgages, like that, when the borrowing costs are so low, they talk about like what happens is it can overstimulate the economy and it runs too hot. So that, in essence, is what eventually led to like 2021, 2022, 23, when you heard all this talk from the Fed about transitory inflation, when they thought it was too high just temporarily, but it wasn't. It was because the economy was running too hot. So that's when they jacked the rates up. Like, if you remember, it was crazy in the news, like ridiculous. Like, I think at the times they were doing like 0.5% hikes and doing it every quarter.
So I've got pulled up here, and this is probably one of those where when we do our post editing, one of us should figure out how to put up the infographic on the screen for it. But
yes, if you can share your screen, it does show.
Really?
Yeah, it's really easy.
Oh, that's cool. So I'm gonna go ahead and share this, and this also pulls in the tab, so everybody who sees this can also see that yes, we are literally doing research on air.
Oh, that's such a good chart.
Yeah, so prior to and this, it only lets me go back like for 5 years, and then they want me to pay them money. So like true accountants, fuck that, I could find it somewhere else. But for the purposes here, it wasn't until March of 22 that they actually increased the Federal Reserve rate. It was basically all those periods of the interest rate dirt cheap mortgages were directly driven by the fact that the rate was effectively near zero.
Like, yeah, literally.
Because they were terrified during COVID with how fucked up everything got, that if we restrict things anymore, it's going to bring the whole system to a crashing halt.
Right, because that's what, if you remember, and like for our listeners who, if you remember, like around that time they started hiking the rates, they started talking about a soft landing, you know, versus I guess what you would call a hard landing or a recession.
They were, I think what was probably it is so difficult to remember. I tell you, nothing better than starting a business during that time to basically lose any concept of what was actually happening during that time, where I was so focused on the day-to-day minutia. But I'm sure was at the forefront of their minds was trying to avoid an 08.
100%.
Of an actual crash like that, because we were, I mean, man, it really, it was rough.
Well, and you mentioned it earlier with Silicon Valley Bank. I mean, that's literally what happened. Like, that was different. 2008 was because banks were just loaded up with shitty assets that went bad. This time, like Silicon Valley Bank, that bank run was literally because of the interest rate hikes.
Yeah. So to do a 5-minute compare and contrast. Basically, the short version is go watch. There's a third one that I haven't seen. I think it's Too Big to Fail is the other movie. But Margin Call and The Big Short do a pretty good job of kind of doing a dramatized retelling of things. Basically, 07 and 08 was caused by the fact that you had shit tier mortgages getting packaged up into financial instruments. Again, going back to our initial thing of how do you even create a financial instrument in the first place,
Yeah.
where you basically had a bunch of interest rate sensitive mortgages owned by people who could only barely make their mortgage payments that, you know, got packaged and repackaged and repackaged and resold and resold and resold. And suddenly you've got these investment banks that had exposure to losses that were extreme, that nobody actually, they knew something bad was going to be coming, but nobody kind of fully realized how much it had gotten out of hand because it was pulling in a lot of monies. The credit rating agencies were, I mean, it just, everything got out of hand. It was the banks being fucky with what they were doing.
Yep.
And the real estate bubble and all that it kind of propped up due to the, again, easy access to money drove up all these real estate prices because anybody could go out and get a loan. And so that can kind of be an intuitive, you don't have to worry. The banks weren't worried because you've got these houses that housing prices always go up. Somebody defaults, whatever, repossess the house, sell it to somebody else, we get our money back. Not a big deal. That is different than all that basically collapsing at once hit the overall stock market because you also had pensions and retirement accounts and things that ended up holding either directly or indirectly these assets that suddenly tanked, and then everything went to shit. And so you've got hedging instruments that triggered that then started fire selling assets, and it just got out of hand from there, and then the government had to basically step in. They were fucky. Now, all those loans were repaid back, so we do want to say that. So if you ever see in there that, you know, oh, they got this bailout money, it was paid back to the government. So you want to say that one. They didn't just get free money and walk away with it. They repaid the loans. That is different than basically everything we've got going on now in housing prices now. Housing prices then were propped up by a bunch of fucky bank shit and easy access to capital that everybody could qualify for things that they absolutely shouldn't be.
Yeah.
Housing prices now is more driven through direct supply and demand because people have mortgages that they got. Does it let me in the screen share draw on the screen? God, I would please tell me.
Go crazy.
Oh, let me. No, we need to figure this out because then, man, I'm gonna be drawing on.
I was gonna say I can't see anything if you're doing it, so.
No, usually at the bottom there's it doesn't. We'll have to look this up after the fact.
Yeah.
Because man, if I could draw on this and pull this up, then we're gonna hit the next level. Man, YouTube loves that shit. YouTube absolutely loves a real good clip of here's what we got going on. Oh man, I hate that I can't draw on this right now. It's weird we can't.
That would be pretty sweet.
I'm so tempted right now to hold on. Let's we'll figure it out later. But basically, because I know we can kind of see it on the screen. I just can't do really fancy drawings. All the people that have those really dirt cheap mortgages were the ones that got their mortgages before the stairs. Back when the rate that the large banks could borrow from the regional banks was effectively near zero, that's why you got your 2 and 3% mortgages.
Yep.
And then, like you said, up, 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 up. Now we're at 5.33. I actually forgot that they cut the rates a bit last year.
I know, I did too.
Wasn't a big deal then, but you know, with inflation kind of still creeping up, unemployment starting to creep up a little bit, I guess everybody's getting a little bit. Yeah, I mean, this is
I think they're getting
wild.
spooked. Yeah, it's a really good chart.
Yeah,
it shows you just how dramatic it is. You know.
Yeah, and I mean, they even over here they mentioned the highest it was ever at was 22% in 1981.
Jeez.
Because it's the other thing to illustrate to everybody here. See if I can do this in like 60 seconds to make for a good clip. I challenge myself here. The reason why it's such a delicate game with this when they get into the supply of money is let's get real topical here. We're going to talk AI for a moment. What everybody's calling the AI bubble and saying that we are in an AI bubble. Probably, yes, there's a bubble going on that is propped up by huge fucking spending Also, fun fact, usually most of those large projects are not paid for by the companies themselves. They have banks that give them the funding for that and then make payments over time. So even when you're talking about billion-dollar contracts, there's still an element of they're paying with somebody else's money. But AI, shitload of spending. Topical thing is that I think it's OpenAI and Oracle. They just signed a contract for, what was it, like 3 billion, 30 billion? I want to.
I didn't see that.
Hold on. I do want to pull this up because it's a. I'm sorry.
It's 300.
Not 3 billion. Not 30 billion. $300 billion.
Incomprehensible.
A number so large, it is quite literally incomprehensible. Never mind the fact that this is OpenAI purchasing computing power from Oracle. I'm pretty certain this number is far in excess of their yearly revenue.
Like, it's gotta be. It's gotta
be. Far in excess. Yeah, also right here. Literally, it far exceeds OpenAI's current revenue. Oh, they've hit 12 billion in annualized revenue. How does it feel to live in the world where we can't go out and spend literally 30 times our yearly revenue like that?
It's just funny money at this point.
I mean, so, all right, well, not technically 30. If we're being correct, it is a 5-year contract. So we take 300,000 million billion. I love when I start punching in numbers where it has to get smaller on the screen.
Yeah.
Where if we take that over 5, so they're spending $60 billion a year, annualized revenue is like 12. Okay, so it's 5 times yearly revenue right now. But you've got all this money pumping into AI. And the reason why we get into velocity of money and why the Fed is so concerned, and you may hear things like the economy is running hot, is it's got to be something relating to human nature. Right? You get all this money pumping into something, and there's easy access to capital. People can spend money on whatever. Again, it stuff just pours in. Where easy access to capital means you can go out and spend money, because if you need to get more money, you can go out and get more loans to then cover the spending that you're already doing. So people start doing these projects, AI, they start spending all this money. Fed drops the rate all the way to 0, supercharges all the spending. Everybody is going out and doing all these loans and everything. You end up in almost this race game of somebody eventually will have to pay for the loans and the lending that is happening, and that's going to come down to consumers. If the consumers slow down on their spending, as you've got the large companies, AI, for example, they're spending all this money basically in the hope that they are going to be able to derive more revenue from it than they're currently spending, or that the loan payments are going to happen, right? OpenAI has signed a contract far in excess of their yearly revenue. Oracle's going to want to be paid. OpenAI is probably not going to be the ones paying. They're going to try and get some sort of lending to cover that, because otherwise they can't just empty the account. They still have to make payroll. People actually have to be paid. So when you start to look at these deals, cutting the rates can actually make some of these deals more feasible, because the cost of the money that they're borrowing gets cheaper. But the concern is that if it goes too low and you again get easy access to money, people will spend more on it. They will borrow more. They will spend more. Things will go faster, which drives prices up, because you could basically look at every cycle through, basically has a new opportunity here for every time that happens for prices to go up. We've already got some inflationary pressure just because of tariffs. It is what it is. Coffee, for example, cost of coffee has gone up a whole lot. I actually had a client this morning telling me about it. So the concern here is that if they go too low too fast, everyone's going to start spending stuff, and it can turn into an issue. And if they don't do it fast enough, people won't spend money, and it'll again turn into an issue. So it's a real delicate balance here of, how do we keep everything from either grinding to a halt or going off the tracks. That was not 60 seconds. Again, you try to explain one little aspect of any of this stuff in a topical manner, and you can't you can't inform someone on one thing without giving the other context, which requires other
Right.
context, with requires additional context.
Yep.
It is difficult. I think that the big thing is if the Fed cut does what they want it to, it will make it easier for companies to borrow, which then funds projects, which then results in more money going into consumers' pockets, usually through wages, which then means that the businesses can then receive that as they do their normal spending. Part of the concern is that as things get too expensive through inflation, your consumer-driven businesses will start to get negatively impacted, which we have seen in some of our clients. I unfortunately actually had a conversation with a client yesterday where they probably by the end of the year they're looking to basically do an out because they're not generating profit, which is a really shitty conversation to have with somebody.
For sure.
So as they're already starting to see some of this, where as things get more expensive, consumers stop spending money. We are dependent on consumer spending. For me in particular, I deal only with businesses. So I don't deal direct to consumers. So I'm reliant on the businesses that sell to consumers to continue to exist so that we can provide service to them. So we are 2 degrees of separation. You deal both with consumers as well as people that, direct into it, deal with it as well. So the concern here is if we cut too quickly, it overshoots, and if they don't cut enough, it's going to slowly grind to a halt, and that I think is where the Fed's mind at. I'm trying to keep this easy to wrap your head around, but it is complicated for normal people. What does this mean? And the answer is both not a lot and also a lot.
Yeah, and it's just the push and pull. I mean, I think how you explained it earlier, kind of as it's just a big circle of how money flows around, and the quicker you make it around the circle, it is going to heat some things up that you could end up shooting yourself in the foot, essentially, if you make it too easy to do these things. But if you make it too hard, you still lose. So kind of a lose-lose, but if you find the right balance, it's a win.
I think what they're also probably hoping with this is the drop in rates may start to free up people for easier to get lower interest rate mortgages, which will start to loosen up some more of the housing supply.
I think so. That's going to be a huge piece of it.
It really is one of those where this means for the average person, nothing in your actual day-to-day life, because nothing you're going to deal with in your day-to-day life is going to immediately change because of a change in the federal funds rate. Yep. It's not something you're going to see in the day-to-day, but you will be surrounded by it through the costs of everything, through the employment rate, through capital projects. So it's in a weird way, it almost becomes like a deity. It is around us at all moments. The Federal Reserve is always here. It is always surrounding us in everything that we have to deal with in our day-to-day, and yet we're never actually going to see it.
Yep.
So, does that make Jerome Powell Jesus Christ?
He is the universe.
For now, until he may end up being replaced. But
yeah, man. I mean, I think that was I hope that helped explain it to people who are, wondering. I think that was a good explanation. If I can pat ourselves on the back, But
I think if people can just have a little more context as to what all this actually means, and it is one of those where I'm sure as they talk about this again, we'll talk about it again, because this is not a easy thing to wrap your head around, because it is true that when you really look at it objectively, much of how the economy functions is quasi made up. Accounting's fucking made up. But, it's still, because this is the system we're in, and this is the the system people believe in and how everything kind of does flow through. It is both made up and also very tangibly real. And it
Yep.
I think bears repeating so that people can understand what all this actually means. Because then otherwise you're going to see headlines, you're going to see people talking about, they're going to pull little clips of from the Jerome Powell speech, right? They're going to pull a little bit, it's going to make a good soundbite, they're going to push it up on social media, and they're going to scare the shit out of everyone. By the way, buy my book because I'll explain what all this really means. There was a Plain Bagel episode, love his channel. Shout out to the Plain Bagel, who doesn't know we exist and doesn't give a shit, but was part of the inspiration for why we wanted to do this anyway, because he does a really good meandered reading, where there was a big hullabaloo on the Fed basically saying we're not going to target 2% interest, or not interest, Jesus, 2% unemployment. And it was they're not looking at unemployment anymore, and the sky was on fire, and this is it, and oh my God, it's the end times. And basically it was a average 2% over a period or something. I'm going to be honest, I don't fully remember, because basically somebody takes some screenshots out of context and ran a whole bunch of shit with it. And so,
Yep.
just make sure that you do not just assume when somebody says things that you just run with, that what they're saying does make sense. Somebody who actually understands what they are talking about will be able to explain it to you in a way that makes sense. Somebody looking to bamboozle you is going to try to make it sound as complicated as possible.
Right. And I think we even got into something similar to that in like last episode, or I don't know, recently, but if somebody's going to explain it to you in a way that you can then understand, that's gold. if you leave more confused than you started, that's, they are, like you said, trying to bamboozle you. And that's what I always caution clients and really anybody about, just looking at the news or the finfluencers who are always talking about, market crash 2025 is coming. Like the Fed's going to decrease the interest rate half or 0.25%, and it's going to wreck the entire economy. It's not going to happen exactly like that. I can't guarantee that the market is not going to crash tomorrow. If it happens, I can't guarantee that it's not going to go through the roof tomorrow if it happens. But, as most things tend to turn out, it's probably going to be just pretty much the same as the last few days have been.
And like most
it's just going to be normal,
It's not going to be the extreme good or the extreme bad like most things in life. It's going to be somewhere in between.
Yep.
Man, it's amazing how we can spend literally over an hour basically talking about the federal funds, right?
that was a fun-filled topic for sure.
This is a genuine request for our listeners. I know we do have a few. I have talked to some of you, and I value every minute you spend listening to this.
Seriously, thank you.
We do value everyone who listens to this, because we are trying to do our tiny little part, as we are trying to be less just a lecture style and a little more, topical culture, that kind of thing, a little more of a lifestyle type thing. I don't know. We'll see what happens in the future, but this feels a little more sustainable than, picking a topic like we were doing in the beginning. But if what we've said is making sense, please let us know. And if what we're saying isn't making sense, if there's a part of the video or whatever where you went, wait a minute, can you explain this in more detail? Please let us know, because we want to make sure that everybody listening is truly informed correctly as to what is going on. And if you want to know where we're pulling information from or whatever, we will gladly share that with you. We're not going to bamboozle. I've got better things to do than try and do something like that. I don't make my money on selling shit to people like a book. I make my money when my clients make more money. And my clients operate in reality, which means we have to understand reality. Maybe we'll do the book thing
100%.
at some point so we can shill it. But, for the time being, our clients have to be doing well for us to be doing well. So we are dependent on their overall well-being. So
Yep.
we want to make sure they are as informed as possible. And, you deal with individuals even more so, which I know is even rife with more. But
Yeah, absolutely, man.
You got some closing remarks for us there, Mr.
Yeah, I think
Mr.
you hit it on the
Bannister?
head. Just we'll see what happens tomorrow. It'd be really interesting. Yeah, and I think we mentioned it earlier, but if there was something that you think was incorrect, or like more about it, if you're a banker or like anybody who knows more about it than us, like comment, let us know.
I mean, hell,
We want to hear it.
if you really know it, we'll bring you on for a special episode so
Yeah.
you can literally explain to us this is what you guys were wrong about.
Or if we're right, then please sing our praises.
All right, if we're wrong, we'll kind of figure out how to tweak it so we don't look terrible. But if we're right, we'll definitely bring you on and you can say how amazing we are.
There we go. Like it.
And I think with that, we've talked enough. I think these are starting to get longer and longer. I'm wondering how long you think it's going to take before our first 2-hour-long episode. See.
We will see. It'll be a good topic.
I'd have to do a part 1 and part 2 on that. But as always, we appreciate everybody that listens. Keep up the good fight, and we will see everybody on the next episode. See you then.